Continuing our review portion, now we're going to remind ourselves some inventory pieces. Talked yesterday about recognizing revenue. Now we got to remember, well, what's that flow of inventory? So you'll recognize the diagram here. We've got our beginning inventory. It's what we start with as a merchandising business. During some point, we buy. If we never sold anything, it means this is the amount of merchandise we have for sale. If we're terrible at our job, this is what we have. Since we're not, that merchandise becomes one of two things. Either it does stick around because we don't sell it, or it turns into cost of goods sold. That cost of goods sold piece is rather important because, as you can see, it impacts quite a number of things. Reminding yourself about that net income calculation, revenues minus your cost of goods sold, give you gross profit, take your expenses, and you get net income. So if inventory is too high, well, what is going to happen to that cost of goods sold? If the ending inventory up there is too high, it means your cost of goods sold is too low. If cost of goods sold is too low, then net income is actually too high. And then, of course, if ending inventory is too high this period, next period it'll also be too high as beginning inventory. So there's a big impact here. So we need to figure out what's a good way to value our inventory. And you're going to look at it from the sold perspective. So we've got some methods of costing. We talked about specific identification in class. Technology has made this very possible. But a lot of times it takes items that are unique. So like we did the M&M's example in class, that doesn't really work well because they're all the same. You go into a grocery store, those 2-gallon cartons of milk, they're all the same. Let's use a societal reference right now, the roll of toilet paper, they're pretty much all the same. You can't specifically identify those. So how can we figure out which ones we sold? Well, we've got two methods we can pick from. Actually 3, but we'll use 2. LIFO, which, if you remember right, last in, first out. So the last inventory we had is the first inventory we sell. Or you can use FIFO, which means your first inventory in is the first inventory out, or the first inventory you sell. There are a couple other options, one being weighted average, although this book doesn't address it. And so when we think about, all right, in a time of rising costs, which method is going to produce a higher net income, which this period could be very important for each and every public company. I mean, we got to remember that FIFO is going to give you that higher net income. In terms of reporting, consistency, we need to make sure we're consistent. There's your accounting concept right there, using the same accounting methods each period. The IRS and the SEC says you must use the same method for tax and public reporting. You can't just pick one for one and one for the other because one will generate a higher net income than the other. For GAAP purposes, you must use the same method from year to year. If you want to change, you've got to show your cumulative tax adjustment, income adjustment, and then pay tax on the additional income that you need to record. And using the same method will allow an accurate comparison, especially for your cost of goods sold and for your inventory. And if you change, you must show the difference and the effect of that change. So using that information, I'm going to give you a problem here to work on. Please get it back to me. If you have any questions, please let me know.